We are going to raise domestic bonds. We have enough cedis in Ghana to pay for our cocoa.
In the past year, the Ghanaian economy has staged a remarkable comeback. The cedi appreciated over 40% against the US dollar in 2025 alone, and inflation has fallen to the lowest since 2021. But just 3 years ago, the story was very different. Overambitious fiscal policies and rising debt plunged the country into crisis not seen in over 20 years. Inflation soared above 50% and the cedi lost nearly a third of its value.
If the fundamentals are weak, the exchange rate will expose you.
But if the exchange rate moves, you cannot jump to that conclusion that the fundamentals are weak.
Over the past few weeks, I have been looking at this chart. It was published by the Bank of Ghana, and the goal is to find out how and why Ghana's economy crashed in 2022. I'm also going to show you how the economy is making a comeback.
Something good is happening. It's not about over-injection of dollars. If you have the productive capacity of the country being utilized effectively, and then exports are increasing, clearly you will have some stability in the macroeconomy.
But if I look at the Ghanaian economy at the moment, it's doing, let's just be honest, it's doing terribly.
Not terribly. I don't know the economy in the world that's doing well. Tell me, where you are here, the highest inflation.
Well, 15.7%. The Ghanaian cedi has fallen 20% on the dollar, the worst after Russia, which has a lot of sanctions against it.
For many Ghanaians, this interview is an ominous look back at 2022. But let's rewind for a second. In 2019, Ghana was being described as a rising star in Africa. Growth was strong and social spending was expanding. Then the pandemic hit. Government spending increased significantly, but revenues didn't keep up. This created a deficit that needed financing. To finance that deficit, the government borrowed. Domestic debt increased by around 45 billion cedis in 2020 alone, and 42% of that figure was financed by the Bank of Ghana. When a central bank finances government spending, it creates new reserve money. That new money enters the banking system as liquidity. A large portion of that liquidity injection, in our case, went into recurrent expenses like wages, interest payment, and consumption, rather than investment that would expand the country's output capacity. So you had more money circulating but less than proportionate increase in production. More money chasing limited output is a recipe for inflation. And that's exactly what we saw.
Ghana's inflation has surged to almost a 3-decade high.
To contain that inflation, the Bank of Ghana raised the policy rate aggressively. The goal was to make borrowing expensive and drain excess liquidity from the system. But higher interest rates also increased the cost of servicing the domestic debt. And by that time, the government had accumulated a massive domestic debt stock. So the more borrowing rates went up to fight inflation, the more the interest payments on the domestic debt also went up. Eventually, the government couldn't sustainably pay off that debt, and it couldn't borrow internationally. And that's how we ended up with the IMF and the domestic debt exchange program.
Our domestic debt operation involved an exchange for new Ghana bonds with a coupon that steps up to 10% as soon as 2025, with zero interest in 2023 and the first interest payment in 2024, and longer average maturity for the bonds.
That was a big deal because government bonds are usually rated risk-free. So for there to be a need to suspend payment on those bonds totally reduced the confidence of investors in the economy. But holders of these bonds were not just individual investors. They are your pension, your banks, and your mutual funds. But fast forward to 2025, the picture looks very different.
We refer to this process of recalibration as our reset agenda.
In just 8 months, we have achieved significant reduction in inflation from 23.8% in December 2024 to 11.5% in August 2025.
So, what changed? 3 major factors contributed to this stability: gold board, fiscal discipline, and the IMF. One of the most visible shifts is the introduction of gold board. Gold board was positioned to buy and export gold mainly from small-scale miners. But before that, a huge part of that gold was leaving Ghana illegally, depriving the country of the much-needed foreign reserves.
If the gold board was not introduced, those who were taking the profits from the small-scale mining sector were the foreign traders.
Gold export generates foreign exchange, and foreign exchange strengthens reserves. Stronger reserves gives the government breathing room to make external payments without putting immediate pressure on the cedi. It also allows the central bank to intervene in the forex market, introduce more foreign currency during high demand import periods, and this is exactly what was done. This was combined with the relatively stable expenditure profile coupled with the significant increase in revenue. This shrank the budget deficit and reduced the need to finance the difference through borrowing, and this was in part due to IMF restrictions. The domestic debt exchange program introduced in 2022 pushed a large share of the government domestic debt repayment into 2027 and beyond, easing immediate repayment pressure. Today, the economy has stabilized, the cedi has strengthened, and inflation has fallen. But stability is not an event, it is a policy choice repeated over time. And the real story going forward is whether those choices remain constant.